Hello, Ian Harris from Watson's Estate Agents. It won't escape anyone's attention that interest rates have just gone up. There's a cost of living crisis, or so it's portrayed in the media. There's general economic pressure around. So I thought I would just talk about this in terms of financing house purchase. And today I'm joined by Greg Marcham, who is head honcho at Yellow Bricks Mortgages. They are an award-winning mortgage brokerage that we work with to help our clients. Greg, hello.
Hello, Ian.
So just in summary, what has actually happened with interest rates and what effect is it having on the mortgage market at the moment?
So it's quite early days, I suppose, but the first thing is obviously the rates have gone up, and they've gone up for the first time, repetitively now over the last couple of months, for quite some time. So I think with that, there's a perception, but we're regularly reminded of the cost of living crisis through the news. But in real terms, if we're trying to control, they're trying to control the inflation that's having such a big issue within the UK at the moment. So it's a simple model that ultimately the higher interest rates lead to a higher borrowing cost, and then people spend less, and then ultimately the demand drops. And from that, inflation hopefully falls. So you can see the logic behind why it's being done. I think there's a little bit, I suppose, a fear factor when interest rates goes up as to what's going to happen. But if we look back to the 70s, I suppose, so interest rates across the whole of the 70s between 5 and 17%. So I don't think anybody should be getting particularly petrified at this point at 1.25. Certainly when I took my first mortgage, I would love a 1.25% interest rate. So it's not, it's possibly not as bad as it's being perceived to be, but ultimately it does have an impact. So to give you an example of that, if you borrowed £100,000 a week ago, and you allowed for the fact that the rate's going to be somewhere in the equivalent of where that base rate was, and you move that forward for the same £100,000 by 0.25%, the cost is actually around about £11 per month. Okay, for £100,000 worth of borrowing. And obviously, the larger the mortgage, the bigger the impact, but also you'd argue the larger the mortgage, hopefully the bigger the income that's coming in to support that. So the impact shouldn't be critical. But what you have got is obviously other costs then being increasing alongside, which is starting to then put a challenge. So the mortgage market at the moment, I would suggest it's more about the perception that might prevent people moving rather than the reality.
Yeah, I think certainly we've noticed that rents, which is the alternative to owning a property and buying, they've gone up in the last 12 months, and those increases have been in the order of probably £75 a month on some properties, which that puts some kind of scale on that. So obviously, interest costs feed into affordability, as do people's day-to-day expenditure. So has it affected borrowing capacity for buyers at all?
No, I mean, ultimately, borrowing is going to be based upon the income that's coming in and the guaranteed expenditure that's got to go out. So at this point in time, it's not having a great impact, other than I suppose you could argue that if people do start to struggle, there is every chance they could be spending more on credit cards, they could be taking more loan payments, and therefore actually that then becomes a commitment that would reduce your borrowing capacity. So there are some things that may happen that might reduce your borrowing capacity, but at this point in time, in real terms, there was an announcement yesterday where the government are looking to strike off with lenders affordability, which has been the way that a mortgage has been modelled now for quite some years. So they're talking about abolishing that. Julie, that will potentially take us back some years to a marketplace where there's a little bit more flexibility around what you can borrow, as long as you can afford it. But it won't be just purely validated on their background affordability test.
Yeah, well, that's encouraging news. Obviously, with so much changing at the moment, is there anything borrowers could do if they're considering buying a property or indeed remortgaging? What could they do to protect themselves against further changes in interest rates?
Yeah, it's a really interesting one because the first thing is obviously you've got individuals that have a variable rate mortgage or a base rate tracker mortgage, whatever that may look like at this point in time, where their rates are going up. And it's the first time, certainly in many, many years, that we've received calls in saying, actually, my fixed rate's not up till 2023, but we really would like to secure now, and we'll pay the early repayment charge to get ourselves back onto a lower rate because they're concerned about further uplift in the rates. So it's something new to us. We haven't seen that over the last certainly the last 5 to 10 years, which the existing customers that primarily have signed up over the last 2 to 4 are either on 5-year deals anyway, and at this point not impacted. So if you're on a fixed rate, it makes absolutely no difference. But you just got to take a little bit of I suppose, a look at when your fixed rate is going to conclude, and then judge whether it's worth jumping ship or not. It's a very hard one to do without a crystal ball, but it's more about the security that the individual wants rather than actually being able to make a guaranteed decision on things.
Yeah, sure. So well, that's good news, because I think trying to protect yourself at the moment, I think, is a concern for people. One of the things that we have noticed as well with cost of living, particularly around fuel costs, energy costs, so that cars and houses, people are thinking about a move to something that might be a little more economic, either nearer to a place they go regularly, less rooms to heat, smaller rooms to heat, those sorts of things, and the downshift that goes with it often brings putting some money in the bank. So if somebody is thinking about doing that, is there anything, any ideas around what people could do with cash, perhaps on the investment side of things?
Yeah, I think it's again, it's a very individual decision, that, isn't it? So if people are generally making a move because they want to decrease their outward expenditure and they want some security, placing that money that they place in security in different assets or whatever it may be could be risky. So I think obviously you've always got the housing market, so you can spread that over a deposit for a buy to let, and there's not many landlords where their monthly mortgage payment is at a level where it's above their rental payment, so there's an income you can achieve from that. Beyond that, there's obviously some options in respect of when the interest's going up, it's more advantageous to have funds within banking institutions. So there's different investments. Obviously, your return will be better. So whether it be secure bonds or whatever that may look like, but I say that's certainly something that I think with a wealth advisor, you get the right answers from that, but based upon your own individual circumstance. But I say for borrowers, it's not, in summary, not horrific. Looking at those numbers, in respect of people with money in the bank, they're probably starting to enjoy their money going up a little bit each month now, because they've got to invest in the rates that they're getting are therefore better. So it's just, I suppose, where you are within your life and what you're looking to do over the next couple of years.
Great, that's all fantastic advice, and I think probably underlines the point that I always make to people: get great advice, and Watsons and Yellow Bricks together are a great place to go and get it. Thank you, Greg, for your time.
No worries, thanks, Ian.
Thank you.